Good afternoon, and welcome to our webinar series, Bridging the Health Insurance Gap Before Retirement. Thanks so much for joining us. I want to mention a couple of upcoming chapter events. We've got a member meetup, virtual mastermind style networking on April 24th from 8 to 9 a.m. Our annual regional symposium on April 30th from 8 a.m. to 6 p.m. Please sign up today for that. It's going to be a wonderful day of educational content and networking. Look forward to that. Webinar series, Top Estate Planning Pitfalls Advisors Should Help Clients Avoid, on May 20th from 12 to 1. Webinar series, Exploring Charitable Options for Your Clients, on June 3rd from 12 to 1. And last but not least, our webinar series, Ethics and a Practical Application of CFP Board's Code and Standards, on July 29th from 12 to 2. This will get you your 2 hours of ethics requirement for CFP. Check our website for details, updates, and register now. We are thrilled to be joined today by Steve Vollenweider, owner and senior broker, Best Plan Insurance. Steve was a banker out of college with the forerunner of Truist Bank. Before we dive in, please use the Q&A feature at the bottom of your Zoom screen to share your questions or comments throughout the session. We want this to be interactive and valuable for you. And with that, I'll turn it over to Steve to begin.
Well, thanks, Kathy. Can you hear me okay, Kathy?
I can hear you well, but we've lost your presentation on the screen.
Well, doggone it, that wasn't supposed to happen. So hold on here. See, I was afraid of that. Hang tight.
Okay.
I can see you there. I want to share again. There we go. And we're going to share again here. And Kathy, tell me if you can see that come up.
Yes, sir. We're on the first slide. Thank you.
And can you see the whole screen today?
I can.
You can? Good. Well, you're doing better than me. So, folks, real quick, I'm Steve Vollenweider. I own Best Plan Insurance. And I appreciate Kathy asking me to come along and talk about health insurance on, of all things, April Fool's Day. So I wasn't sure if she was kidding me or if she was being serious, but maybe it's appropriate to talk about health insurance on April Fool's Day, given what the current environment that we're kind of in these days. We're located up about 3 blocks north of downtown Cumming on Highway 9, right here, like I said, in Cumming. We work with 3 downline agents in our agency, and we try to keep things very simple. Our email is steve@verybestplan.com. What I would like for us to do today is, let me just see if I can, there we go. Kathy, did that change the screen?
We're just still on slide 1, Steve.
Okay, let's take a look at this one. Hang tight. That one, are you on Bridging the Gap to Medicare?
No.
Okay, I got one more to try. Okay, there we go. Bridging the Gap to Medicare. Do you see that now?
I do. Thank you.
Great. That's again, guys, sorry about that. Today, we're going to be talking about a very select group of folks that you're going to probably come across in your world, folks that are approaching Medicare age but are not quite there. And for a variety of reasons, we're trying to find insurance, health insurance, between group insurance that they're coming off of and Medicare. And I'll give you a few examples today of real life clients that actually came across my desk the last few days that are in this exact situation. And also, just to give you a little clarity, I'm actually 63. And so I'm kind of in that I'm living the same thing that a lot of these folks are living. So it's kind of nice to know that I'm not only working with clients, but I'm having to kind of understand it on a personal level as well. Before we actually get into the the discussion today about bridging the gap to Medicare, I want to explain just a little bit about what our firm does, what arenas we kind of work in with health insurance. For the most part, we work with individuals and families that don't get group health insurance. That could be a variety of folks. It could even be folks that do get group benefits, but maybe their spouses or dependents, it's too expensive or something that doesn't fit their budget. Those are folks we work with as well. We also work with Medicare clients in our firm, as well as life insurance. Additionally, and with Medicare, we work with both Medicare supplement plans and Medicare Advantage plans, as well as prescription drug plans. We also work with health reimbursement arrangements and minimum essential coverage plans for employers. What we really don't do with our firm is work with traditional group health insurance. That's kind of a whole separate group of just a different world. And you kind of have to be equipped to handle group health with compliance and customer service. We're more the other guys. Okay, so we handle a little bit of everything except traditional group plans. We're a brokerage, and so when we look at options, we're not a captive agency. We're not tied to one carrier and only representing one set of plans. We're actually licensed with over 25 carriers in the state, all the big players, and we look at those very closely, and we do kind of get rid of some of them, and we do try to add as we see fit that's going to best work for our portfolio and our clients. But this is just a small, I think this is about 14 of the 25. But and like I said, we're licensed with all these folks. We train with all of them, and we're well versed in the different plan options. Most agencies have multiple state licenses. That's not uncommon. But what is, it's not uncommon to have multiple licenses across several states. Once you have an insurance, a health or life insurance license, you can get a license, a non-resident license in any of the other 49 states you want. It's just a fee. There's no exams or anything like that. So we try to keep it manageable, and we only have clients in these particular states. I did have a financial planner ask me the other day if our firm was licensed in Wyoming. And I had to tell them no. There's just not enough business there that would warrant us getting a license for $150 every year or two, just to try to keep a little book if one or two clients, a single client. So most of ours is centered in the Southeast. And to be perfectly honest with you, we are very, very well versed in Georgia. We seek out business in Georgia, but we do not seek out business in these other states. When it comes to us through referrals, we will definitely help them. But we do have affiliate offices in West Palm Beach and in Fort Worth, Texas. So we can look at, helping folks that are a little bit more state-based. But just to kind of let you know how we operate, probably 90+% of our portfolio are Georgia clients, Georgia zip codes. And again, we're going to talk about bridging the gap to Medicare. It is going to be that very select group. And I want to spend a little bit of time here. these are going to, I'm trying, and I really wanted to look at this discussion today really from your eyes and who you'll be talking to. So it will be a little high level. So it'll arm you with some information to help steer those clients, both financially as well as maybe to some certain plans or plan options before maybe turning it over to a broker. But our target market are clients that are going to be moving from employer plans. And this usually is two buckets. We, in our office, we call the spring of each year the firing season, because for some reason there's a large quantity of people in their late 50s and early 60s being let go from some of these big employers. Can't tell you why. It just happens every year. And so what we will see clients that have an active retirement path, and I'll describe a couple scenarios in a minute, or people that were terminated or left their business and received COBRA, and we'll talk about COBRA in a minute. And maybe that COBRA is running out now. Their COBRA insurance is running out. And they're going to be looking for individual or family coverage. This isn't going to be group coverage. These are all individual plans, individual policies with each carrier. Okay. The two scenarios I'm going to mention today is, believe it or not, these came across my desk. It was a husband and a wife out of Decatur, Georgia. He's 63 and she's 59, and they're coming off of COBRA. They've been on COBRA for 18 months, and it ends June 30th. And so this couple has to find insurance in that gap before Medicare. They're close. I had a client I spoke with yesterday. This is a client out of Lawrenceville. He's 62 and his wife is 58. He's a CPA and they have a planned retirement. And his last day, and he's 62, his last day is going to be May 31st, and he and his wife will be fully retired on June 1st. So these are examples of situations that come across my desk almost every week. And so if it's coming across my desk that frequently, I would imagine maybe it's going to be coming across your desk as well. And so we're going to kind of just take a little bit of a dive, not too deep, into the different plan options. As we go through this, I actually shared this deck with the CPA yesterday. There's nothing in this deck that's proprietary. That can't be shared. It's general information. And his comment was, when we got through, was that he said, I felt like I knew about 20% of this. And I think that maybe what will happen today is you probably have some knowledge of what we're going to talk about, but it's a good time to maybe fill in those gaps, maybe give you some affirmation on some things that you're aware of, and maybe give you some confidence when you talk with your clients, instead of just saying, well, go talk to my health insurance broker and then come back and tell me what they tell you. You'll have a little bit more upfront information. This slide I'm showing you now is probably the most important slide of the deck. If you want to take a picture of it, fine. I know Kathy is going to send the deck over to you. You're more than willing to take that and print it out sometime and chat with your clients about it. This is essentially the landscape. When I chat with clients, we talk about, let's share information and talk about the landscape before we try to, sell you some kind of a plan. That's not fair to anybody. We want to make sure you have a good grasp of what's out there. So in the upper left, you'll see it says clients leaving group plans. And those are the ones we just described. And then there's basically 5 options, or I say 4 plus 1, because not everybody is going to have a chance to have COBRA. as an option. For instance, that first couple I just mentioned to you, the ones out of Lawrenceville, well, they're coming off of Cobra. Well, if they're coming off of Cobra, then they only have a chance at one of those other 4 buckets if they want health insurance. But for those folks that have lost their job or have retired, but you still can get Cobra, then those are the 5 buckets that you have at your fingertips. We are going to look at each one of these groups very briefly, and we're going to assign monthly premiums, monthly estimated premiums that the clients might see for each of these five buckets. So the buckets, again, are going to be Cobra, and then you've got Marketplace or Obamacare. Clients have an option of looking at short-term plans, catastrophic with indemnity wraparound plans, and share plans, the MediShare Christian share plans. Those are all available for clients, on that landscape that we're kind of looking out at post, employer insurance. Okay. I went ahead and kept that graphic in the upper right corner so we can kind of refer to where we are in this. So we're going to work from the right back to the left. Cobra, then Marketplace, and onward. And again, chances are you might know somewhat about this. You may have had be part of Cobra in the past. You might have clients that have been on Cobra, but just so that we are all on the same page and that you're comfortable understanding what it is and what it isn't. Cobra is simply an acronym for the act that was passed in 1985 that bears its name. It is, and this is where some confusion comes, Cobra is the same health insurance offered to your client by their company while they were employed. It's the identical plan. Nothing changes. Okay, it's not a new plan. It's just taking your existing plan and you will continue with that existing plan. The group health insurance plan, the Cobra plan, will be a PPO plan. And a PPO simply means preferred provider organization. It's a large network of doctors. In this case, most Cobra plans are going to have a nationwide network of doctors on a large PPO plan. That is standard with group plans. The biggest difference comes is there's going to be no employer contribution moving forward. Up until now, while the client was employed, in most cases, the company was paying 50% of the monthly premium, and the employee was picking up the other 50%. Okay? Or even richer. I've seen richer plans with some companies that really wanted to focus on their employees, and they were picking up to 75 or 80% of their employees' monthly premium. Okay? In a lot of cases, the employer will pay for a part or a half or more of the employees' insurance premiums, but in a lot of cases, they will give some contribution for spouses, but a lot are moving away from that, as well as dependent coverage. They're kind of moving away from that. But again, with Cobra plans, there is no employer contribution, and so those plans will inevitably go up quite a bit, the monthly premiums. The Cobra plans usually last 12 to 18 months, but they can go up even to 36 months. And this is important when you've got somebody in that gap, maybe that 2 or 3 years to Medicare. This could be a good option, although somewhat pricey. And this is an important part too, that fourth little button there. Prior claims against deductibles carry over in plan year. So say you've got a client that is terminated in August and picks up their COBRA plan September 1st. But they've been using that plan throughout 2026. And they paid towards deductibles, they've paid co-pays, they have used the insurance. And so the question is, does the fact that I have contributed to that plan during the year, does that carry over with my COBRA plan? And again, since it's the same plan and we're carrying it over, yes, it does not start over. You do get to carry over anything you've paid towards deductible, max out of pocket, and things like that. It does carry over. It does not start new with your COBRA plan. Most COBRA plans, this is a side note, most COBRA plans are administered by a TPA, a third-party administrator. Most companies do not want to involve themselves with their employees once they have parted with them. So they work with a TPA that will handle the COBRA benefits, handle the COBRA premiums and the like, but the plans will stay the same. Again, these plans can be pricey because in a lot of cases, the employers are picking a very strong plan because they're really trying to insure their employees. They're not as concerned about insuring their former employees. So as employers look at their group plans, you're going to see very low deductibles, maybe $1,200, $1,500, $2,000 a year deductible, maybe $3,000 or $4,000 or $5,000 max out of pocket. Those are very, very strong plans that are, fairly rich and kind of expensive. But when the employer is paying a good chunk of it, half to 3/4 of it, the employee doesn't see the pain of that or the abruptness of it. So when they get that COBRA letter, they can be a little bit shocked. But again, there's advantages to being on a COBRA plan. I took that husband and wife example that I showed you on the prior page. Male 60, female 60. They've been on a COBRA plan together. Typically, we'll see the plan offered to them combined. This is the premiums per month are combined, husband and wife, are going to run anywhere from $1,700 that we've seen all the way up to $3,000. And that's anecdotal. That's what we've seen come across our office here. And that's usually, again, 50% or more than what they've been paying prior to this. Okay? And hopefully that kind of filled in a couple gaps on COBRA. Okay. The second bucket, kind of again working from right to left up at the top there, are marketplace plans. And again, if COBRA is not an option or COBRA is running out, this is kind of the starting point then for clients. They'll have 4 options as part of that landscape. Marketplace plans are also called Obamacare, exchange plans, ACA plans. These were started in 2010, and probably one of the biggest misconceptions is that Obamacare is insurance. Obamacare is not insurance. Obamacare is the framework that the government built for private carriers to work within. Included in that framework was no health questions. Anybody can get on an individual or family marketplace plan with any health conditions. They could have any chronic condition. And there's several we'll talk about in a little bit. But if they have health conditions, then this is going to be their only avenue with chronic conditions. They will not be able to get onto that third, fourth, and fifth buckets, the short-term plans, catastrophic, and the share plans. Those have health questions attached that you have to answer no to, basically underwriting. Okay, there is no underwriting with marketplace plan, and they do not consider pre-existing conditions. You are not held to any kind of a penalty for pre-existing conditions. Okay. Open enrollment for the marketplace is November 1st through December 15th each year for a January 1st effective date, 2027 for this coming year. Now, what will happen is your client will qualify in a special enrollment period throughout the year. If a client comes to you and says, hey, I'm leaving my company business, I'm retiring, or I've been let go of my business, I don't have any insurance anymore, having a baby, moving, things like that will trigger a qualifying life event, which will open up a special enrollment period so individuals can get on the marketplace outside of open enrollment. It is a pretty strict, that qualifying life event, special enrollment period is very strict now with Georgia Access, since Georgia Access has come online 2 years ago. They are very specific about what they need in terms of documentation about getting onto the marketplace during a special enrollment period. And that's the information we gather from our clients as they're coming off of a group plan. Marketplace plans are almost entirely HMO plans. And what is an HMO? An HMO is a little bit different than a PPO. An HMO is called a health maintenance organization. And these have very tight networks, usually not outside the state. PPO plans can usually go across the country. HMO plans are usually even large city-based plans where they'll have just a network, maybe like in downtown Atlanta. Other networks will be throughout the state. But that's the HMO model, and these are very critical because with PPO plans, they do mostly pay out-of-network benefits with PPO plans. They will not be as good benefits as if I'm in network. But conversely, with HMO plans, once you're out of network, there will be no reimbursement. The client will be on the hook 100% outside of HMO plans. So it's we have to be very careful when we work with our clients as we're interviewing and talking with them. We are gathering their doctors, their hospital systems, their prescriptions to make sure we can plug everything in so that when they put the insurance card down, it works with their doctor and their health system. And on a side note, that's probably one of the biggest problems we have with the whole system is that the health systems and the insurance carriers don't always match up. Not every insurance carrier is going to take every marketplace plan carrier that's offered. Okay, so we have to be real careful on matching clients with healthcare systems and the like. That's where I would say if you're as a financial planner, financial advisor, is to say, hey, that may be a little bit deeper than I want to run, but just know that those marketplace plans are a little restrictive, and they do run calendar year. If I get on a marketplace plan in September because I was let go in August or I retired in August, then that plan is going to be good from September through December 31st. and then a new plan is chosen for the following for 2027. Again, these are all private health insurance carriers. You're talking about Anthem, Blue Cross, United, Cigna, Ambetter, Alliant. These are all private health insurance carriers that work within the marketplace. There are no government carriers. Okay. Marketplace plans can be a bit pricey without tax subsidies to lower the monthly premiums because these are guaranteed issue plans. And anybody can get on with any kind of condition, stage 4 cancer, heart disease, it doesn't matter. I'm allowed on the marketplace without any health questions. Those plans run, $2,400 typically when I price this out for a husband and wife. Bronze plans without a tax subsidy are running $2,400 up to $5,200 per month. Okay, a little pricey. Short-term plans, we're going to speed it up here just a little bit. I'm watching our time a little bit and I don't want to run over. The third bucket now, from this point over, short-term plans, catastrophic, and share plans, these are all going to be underwritten plans. There will be health questions. And they're looking for chronic conditions such as heart disease. They're looking for internal cancer diagnosis, both of these going back about 5 years. They're looking for autoimmune diseases like rheumatoid arthritis or Crohn's. They're also looking for diabetes and prediabetes. If you've got a client that's taking metformin for weight loss, that's not going to cut it for an underwritten plan. They'll only be able to go to the marketplace. So those general disease states are what they're looking for. Underwritten plans, they don't really care about blood pressure, cholesterol, anxiety, thyroid, things like that are not chronic conditions that are going to put us in the hospital per se. There are no special time periods. There's no open enrollment, special enrollment, anything like that. Clients can get on as soon as they want. Most of these are PPO plans. They're called short-term plans or private direct plans because they can run up to 3 years in length. A carrier cannot get rid of a client for up to 3 years, no matter what happens to that client, but the client can kick out the carrier as soon as they contact them by phone or email and cancel their policy. There's nothing keeping the client in. Most have deductibles, co-pays, co-insurance. Carriers in this group, again, are United Healthcare, Allstate are big players as well. And you'll notice that the cost of these are a little bit south of what you saw on Cobra and Marketplace plans. Because again, these folks are generally healthy. So the pool of people they're insuring are going to be obviously a little bit healthier and they're not going to run up as many probably medical bills as a person with chronic conditions. And again, they're $1,100 to almost $2,000 depending on deductibles. The next set of plans, again, these are called limited benefit or fixed benefit plans or catastrophic plans. And again, they're similar to the short term in the fact that you still have to go through underwriting. There are no special periods to enroll. You can enroll whenever. They're nationwide PPO plans. They run up to age 65. So you can have a person on this plan when they're 40 and they can stay on the plan for 25 years if they want. Once they're in, they can't get kicked out. So if they have a heart attack at age 60 and they got on at age 50, it won't matter. The carrier still has to carry them until 65, unless the client wants out, and they can get out anytime they want. With catastrophic plans, they pay first dollar benefits, and typically these are catastrophic plans in terms of there's only 2 reasons you go to the hospital or have surgery. It's because you have an illness, you're sick, or you had an accident, you got injured. And so a lot of these carriers will sell those 2 policies or market those 2 policies together, a very rich accident plan, a very rich illness plan. And then they wrap that with a small indemnity plan for small stuff like office visits and urgent care, where they pay a fixed dollar for each type of benefit. Those plans are very attractive for people that are relatively healthy, don't really use the doctor much. Husband and wife, age 60, those premiums run, $900, $1,300 a month. Very, very reasonable. Some of the players in this category are Med Mutual, Philadelphia American, Manhattan Life are some of the big carriers in that world. And then the last one are share plans that somebody coming off of a group plan could get into if they like. These are typically affiliated with a religious or value-based program. And very crucial here is the first line. Share plans are not health insurance. There is no state or federal regulation, and they don't have to pay claims. It's in their mission statement. And in full honesty, we do have two share carriers that we have in our portfolio. We don't really advertise them. If clients are interested and would like that information, we certainly share it and we certainly market it. But the clients have to answer no to the health and the value questions. There are no special periods needed to enroll. And this is where it's really interesting about how share plans work in general. For the most part, clients will self-pay or pay with a credit card for all procedures. And usually there's a threshold, a limit of what they can submit. But say somebody falls down and breaks their collarbone and they have a $20,000 shoulder surgery for fixing their collarbone, outpatient surgery. That's about a $20,000 credit card that they're going to be swiping. And then the client submits the claim after the fact to the share plan. And hopefully the share plan, depending on what they have in their bank account, they will pay supposedly on those claims. I have had mixed review, just anecdotally. Some people like them. Some people have had not great experiences. So it's hard to kind of quantify that. A couple of notes, and this is a nugget I'd like for you to take away today. When I'm working with clients, I can pretty much estimate what their monthly premiums are going to be with any particular one of those four buckets based on their age. So if I've got a male and a female, 60 years old, what I do, I take their age and I add a 0. So it's 600 and 600. And since they're getting a combined policy together, husband and wife, I add those two numbers together, 600 and 600, and I come up with $1,200. That's about what they're going to pay for those underwritten plans, roughly. If you take 60 and 60, add a 0, put them together, 1,200, multiply that times two, and that's going to be roughly what a marketplace plan will cost without subsidies for a bronze plan, and probably in the neighborhood of what they're going to be paying for Cobra. And the thing that goes in the back of my mind, folks, is can clients answer no to the health questions? And I just ask them, do you take any prescriptions? Do you have any health, heart, cancer, autoimmune, diabetes? And here's, like I said, it's absolutely crucial because of the health systems and the insurance carriers. They don't always talk to each other. In fact, the health systems don't talk to each other. So it's kind of these little silos of hospitals and insurers, and it's just a mixed bag. There's a hospital system in Northeast Georgia health systems. They only accept 2 marketplace carriers. But in any given zip code, there's probably 9 marketplace carriers. So each health system, we have to be very careful in how we match those up. And that's why I really ask that you send your clients to some broker, professional broker that can make sure they've done their homework. Just yesterday, I was working with a young client. They're pregnant, and so they're going to be using the Atlanta Birth Center. And between 3 emails and 2 phone calls, we finally figured out which marketplace carriers they accepted, and then we're able to write a plan. With prescriptions, you're not going to see a lot of heavy prescription coverage on those underwritten plans because you're not going to pass underwriting if you have a whole bunch of prescriptions, if your clients have a whole bunch of prescriptions. So If you have expensive prescriptions, those are going to be suited for the marketplace plans. But on those underwritten ones, I would use the GoodRx app, and generics are usually very inexpensive. We do research Canadian pharmacy. We do research Mark Cuban. We do research other resources for pharmacy, but that's kind of a fluid situation each year. And one of the funnier questions we get, I guess it's not funny, and I like to be real clear, we are only paid by the carriers, and that is very, very regulated. We are never getting money from clients. We are never billing clients. If you ever hear of a broker that is billing their clients for their services, I would really look at that pretty closely. That's kind of a no-no. We are compensated by the carriers, and again, it's very between carriers, it's almost identical. So there's very little reason we should ever push somebody to a certain carrier or a certain plan. And finally, a healthy person has 1,000 dreams. A sick person has only one, and that's to be healthy. And so I'd ask, if you can with your clients, tell them to try to stay healthy, because it does make a big difference when they're looking for health insurance. Kathy, I think that's what I've got today. Again, my information is there. I'm a great resource if you just need information to share. That's kind of what we like to do. It's kind of a weird game, this whole health insurance and trying to transfer risk. And we want to make sure we do it correctly. And so we're available if you guys ever need help. We're glad to help you.
Great. Thank you, Steve. We do have a question that's come in.
Okay.
If a client's employer provided health insurance is very expensive, can they opt out and instead purchase a short-term plan or catastrophic plan or share?
Yes, they can. I know with employers in some case, and this goes back to group health insurance, so I'm a little dusty on it. Some plans, they require 100% participation in the plan. But from my knowledge, you can turn it down, and yes, you can. And something they may want to consider is to see if they would give them, some money equivalent or something, possibly in compensation, possibly.
Okay, very good. And then also, she wanted to verify that you are an insurance broker that we can refer clients to.
Absolutely. And I when I work with referral partners, my job is to add goodwill chips to your basket. Mine is not to remove goodwill chips so you can cover something that we didn't do. So we're very, very cautious. We're very understanding of our referral partners, and ours is to bring value, not bring a headache. We're to add to your portfolio, not be something you have to be worried about.
Sure. Okay, now we've got some questions coming in. Do you assist clients in navigating the ACA subsidies regarding how much income they can make?
Yes, that's a good question. What they did this year, this happened yesterday, 28 and 20, the pregnant family, mom and dad, we don't have a baby yet, so we're just insuring the two of them. In 2026, they got rid of a lot of those advanced subsidies because those were COVID era, and they had an expiration of 12/31. Unless feds did something else, it was going to go away, and it did. So now they have a thing called the cliff you may hear about. Oh my gosh, I went over the cliff. So in this case, I saw it with a 28 and a 24-year-old. I also saw it with a husband and a wife that were in their early 60s. The threshold was if they made $84,000 gross combined income, or less, they would receive a subsidy. When audited, they'll be audited on their 2026 taxes when they turn them in early 2027. And the IRS will go back and look at page 1 of their federal tax returns. Down at the bottom Line 11, it's your AGI. So if this couple said, hey, we made $80,000, we're going to make $80,000 this year. So we go do it and they get a $600 a month subsidy. That $600 goes against their monthly premiums, and their premiums might be $400 a month total. They do their taxes next spring, and all of a sudden that line 11 is $90,000. The cutoff is 85. If you make 84,000 or less, you get the subsidy. If you make 85 or more, you get zero. There's not a graduated, downward slide. It's either you get a chunk of change or you get absolutely nothing. So all of a sudden, this husband and wife say, well, we made 90,000. When they get audited, the IRS will send them a bill for those $600 a month premium. So if they were on it all year, they'd get a bill for $7,200, like a tax bill. So that's the problem. So what I do is when I talk with clients, we do talk about income very carefully, just like I explained it, because I don't want them playing a game where they say, oh, it's 80,000 and I'll just, get a bunch of subsidy only to try to, gig it on the back end, because you're going to have to pay the money. It's a federal bill. You can't get out of it, just like a tax bill. So yes, we do talk with folks. We make them very, very aware of exactly how it works. And we ask them if they are not sure to please talk with their tax folks before we start putting numbers down. And they know that number emphatically because they're giving it to me. Yeah.
All right, Steve. Wonderful. Okay, couple more. To best make a referral to you, should we use your email and simply intro via email?
Yeah, that's perfectly okay. And I respond back to you and the client, and then I follow up with you individually on the back end of how we're, very, very lightly, hey, we were able to work with Mr. and Mrs. Smith. We found them a marketplace plan, something to give you how did it turn out? Because you want to know. Yeah. Absolutely.
Okay. And one more, who do you recommend for overseas travel insurance? Do you handle this?
I do not handle that. If you're on Medicare age and you have a Medicare supplement plan, you get up to $50,000 in coverage. There are some very good travel insurance carriers that specialize in that. We don't get a big enough call for us to market it. I want to say Alliant. I don't spend enough time in that world. You might want to AI that question to get a good carrier.
Yeah, and I just saw this morning on the news Allianz and some others. So
Allianz, that was one I recognize. I'd have to go AI it myself. So, but there are some that actually specialize. Yes, you can get it. Absolutely.
Yes, and I mean covered up to I think 100% in this particular situation.
Yeah, so. I think with what's going on, you just want to be able to get home. Or maybe it'll cancel. Stuff like that or whatever. There's some health issues. And really, the health insurance overseas is to essentially get you home.
Yes.
It's not to see your podiatrist in Munich. Okay. It's meant to get you home, and it could be, that's not cheap to get you home, air flights and that kind of thing. So that's what they're trying to do. Now, obviously, if you have to stay there, that's a whole other, but they're trying to get you home.
Okay. Another one here. How do you choose again for a client between short-term and an indemnity policy?
We actually talk about the specific plans and the carriers, and we go over the actual benefits. We go into detail about how those plans work specifically against different, and what we do is we kind of use a pyramid of invasiveness and expense. So we'll say, okay, well, if I'm going to go get a wellness exam, does this insurance cover it? Or if not, what am I on the hook for? I want to go see my primary doctor. That's the next one up. Then I need to go see my specialist, my dermatologist, cardiologist, podiatrist. Then the next cost up is going to be your urgent care. It's Saturday night. I got a bad rash. I probably got to get a prescription, or I hurt my arm. I don't know what it is. Urgent care. And then we go to emergency room. And then we go to outpatient surgery, and finally in-hospital visits. So we overlay each one of those with dollar. Like I said, $20,000 for an outpatient collarbone surgery. I fall down and break my collarbone. Well, I know it's about 20 grand roughly. Well, how much am I on the hook for? In which plan? How does it work? Okay, so then we send it all to them in email format. So they see all the figures. We even say we don't like to sell folks. We just like to give you the information because honestly, it comes to them every single time when you just share. This is how much it is. This is what it is. This is what it covers. This is what it doesn't. What is how? And I always tell folks, look to yourself before you look at the health insurance. Am I relatively healthy? I don't really use it. I just want something to protect my nest egg. Or, hey, I've got 4 or 5 doctors, and it's really important that I see this one every quarter. I've got a couple prescriptions. I've had this little issue going on. Those are the kind of things that we're going to, that's going to help direct us. And then from that, we say, well, these plans won't work at all because you've got a chronic condition. So let's look at these. If they say, hey, look, I'm really healthy, and I just don't want to pay $3,000 a month that, I haven't been to a doctor in 3 years. Well, maybe you want something more of a short-term plan, something underwritten, something that gives you good coverage and protects your nest egg. Okay.
Right.
So that's,
well,
yay.
it looks like we've gotten to all of our questions today. Thank you, Steve, so much for sharing your insight. And a big thank you to everyone who joined us. We truly appreciate your time and engagement. Be on the lookout for a follow-up email with a replay link, the PowerPoint deck, and a brief survey. We'll also include Steve's contact info, which is also on the screen. Your feedback helps us continue to deliver meaningful content and member experience. So thanks again. Have a great afternoon, everybody. Thank you, Steve.
Thank you, Kathy. Thank you all.
Give everybody a lovely Easter this weekend as well. Thank you.
Bye-bye.
Bye-bye.